Hey, what's going on? Anthony J. Cray. Just wanted to talk to y'all about some things going on. Cash value and financial services wise. And just, we're going to take credit cards as a subject right now. So you know how, when you have a certain amount of money, right? And, the money has interest associated to it, right? You have a certain amount of money, you have interest associated, and you have interest associated with the debt. Certain amount of money, you have interest associated with the debt. And a lot of people get excited about credit card offers. Yeah, Bank of America card offering $5,000 balance, especially when you're young, starting out 18, 19 years old. They really start trying to hit you up. Yeah, get our Banking Express card. You can get all kinds of perks and benefits if you get our Banking Express card. We'll give you this rebate. We'll put this amount of money on it. Blah, 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 blah. This is going to work if you get our such and such card. And first time credit card owner discount or something, whatever. They got all kinds of selling perks. So the point is, doesn't matter what they're giving you. If you touch that money at all, you owe Bank of America that money back to Bank of America or whatever the bank is that gave you the money, right? At whatever interest rate that they're charging. And I mean, them interest rates can be high, 20-some%, interest, whatever. They can be up there. Those interest rates can be up there, boy. And when that happens, when you owe that amount of money interest-wise, and it's not in your favor, that's definitely a liability. And you gotta understand, people have to understand that. But people would rather get a credit card from a Bank of America, PNC, whatever it is, and use the credit on a shopping trip or shopping spree, or some people live on credit, and I don't understand it. But while they're working, they don't pay the balance off ever. And so don't pay the balance off. Balance just builds up. Messes your credit score up, because when you owe more debt, your debt to income ratio, you have less income, you owe more debt, you're jacked up on the credit score. So, and I mean, people go for years like this, don't even care. Like younger people especially go for years like this. And then now it's time to buy a house. Now it's time to do bigger things, right? Buy a house, car, whatever. Or buy your own car, buy your own house. Can't do it. Credit score messed up. Debt to income ratio. Do you know that if you had gotten a cash value life insurance policy and been paying on your cash value life insurance for 12, 15 years, by the time you were 18, 19, 20 years old, then you could have that money be something that you can borrow, do a policy loan, and take your own money from your own policy, as opposed to you owing the bank back that money, because under the facade that they're giving you something. They're not giving you nothing. They're putting you in debt. When you have your own policy, money from an insurance policy like the cash value life insurance, that's your money. You don't even have to pay that money back in your lifetime. It's just going to come out of your death benefit. That's what's going to go to your beneficiaries, whoever it is, wife, husband, later on in life people. that you put as beneficiaries, that, you know, whatever that you took out minus what in total the death benefit was, the difference of that is what's going to go to them if you never pay it off. It's crazy. So these policies are smarter to have, especially when you're younger and you're trying to accumulate things. I know it, you know, maybe takes away from the facade of having money, quick money right then and there. You know, I got my Bank of America card. They just gave me $10,000. I'm going to go to Philadelphia and go shopping. You wouldn't want to do that nowhere, especially if you know you couldn't pay that back. You don't have no plan on paying it back. You don't know, you're not really working. You're bouncing from job to job. You're borrowing money from your parents. They don't even want to give you the money or whatever. Why would you do that? You know, get your own thing, the cash value life insurance policy at a young age while you're healthy. Still you can get one as young as 15. Have your parents, you know, open it up for you. You can get one as young as 15. So that way, 20 years later on, at 25 or so, right? Now you're clear. Your policy, you can start borrowing against. You can do policy loans. That's your money. Who knows how much it could have been accumulated over that time, 12, 15 years. You're putting money in it. Your parents put money in it. You got a guaranteed limited amount that you can put on top of the payments that you're making. Man, that money could be, and it's growing and it's compounding every year, compounding interest at like 8%, 12%. That money's going to be growing and it's going to continue to grow. That's the facet of the whole thing, is the money's going to grow. That's how it's going to continue to grow. You can still do policy. You can take policy loans out on that money, and the money will stay in your account. And the bank, the insurance company, because this is run by insurance companies, will give you the cash that you're looking for, but because your collateral is going to be the money that you've allowed to accumulate. That's the collateral that they're using. You just create your own banking system. I just told you how to do a banking scenario for yourself at a young age, because you would qualify. People who are young and healthy with no health problems can qualify for this. You just gotta have enough wherewithal to be like talking to your mom or a guardian if you're not of age, and be like, hey, you know, I was looking at this thing online about cash value life insurance policy. I want one of those. And just tell your mom to look into it, talk to an insurance agent like myself. I'll explain it to her, show you all how it works, set you up with a reputable policy, structured the correct way, right? Because it's got to be set up correctly. If you know, nothing works if it's not set up correctly, right? But yeah, it's real, and it can work for your benefit. But I just wanted to do this video, I'm already 8 minutes in, and start talking about that in that way, because this is the right mindset to have when you're young and healthy in this economy, especially, right? Stop getting these credit card offers and not knowing what to do with them and just racking yourself up in debt. You know, why not get a cash value life insurance policy, 2 or 3 of those, pay those premium payments early, keep paying those, that basically putting all the money that you can, front loading it, so that you can have that money later on to be using as a policy loan. You know, work at Burger King, cut grass, do whatever, put money back into your insurance policy, right? Instead of taking it out. Don't always think about taking money away from yourself. Think about putting money into yourself, putting money away for a rainy day, right? Or in this case, a even more sunnier day, right? Because that's what it's going to be. But anyway, let's talk. Get up with me, and I'll explain more. Y'all have a good one. Happy Father's Day.